Nice to meet you as well. I'm going to mute the phone. I'm out on a street in Chicago, so just keep the background noise down.
Okay.
Sounds good. And I've just started recording, so we're ready to go. So, folks, good to meet you all. And I don't know whether or not you want us to go through the full slide deck or start with questions or give us, or we can give you just a general overview, but all of these are on the table for discussion. How would you like to proceed?
I'll defer to Josh and Brett, since I think I'm pretty far out.
What I'd like to really understand at a pretty granular level is what you actually have done so far and how the underlying economics work. I understand the solar space pretty well. I invested in the wind energy business that's now GE Wind Power and sold it to Enron 20 years ago, more than 20 years ago now.
Sure.
So I know the space pretty well. And I was just struggling when I looked at the materials as to what you had actually done and how the specific underlying economics worked and how much of it was actually something you could prove and show you've done versus how much it was frankly on the come.
Sure. Okay, so let me start out first. Exergy Energy is focused exclusively on making organizations and companies 100% green, 100% resilient, and saving them money. And we do that for a very specific set of customers to start. And those are customers we refer to as always on, meaning they can't go down if the grid goes down. They've got to keep running, and they've got to keep running for potentially a long period of time. So you can think of the classic examples of hospitals and police stations, but there's many, many commercial and industrial companies like that. So think of refrigerated food warehouses, food distribution, blood banks, variety of folks that have to have and currently do or will be purchasing backup generators. So that is our target customer. And what we deliver to them is those three things. We'll make you green, we'll make you resilient, and we'll save you money. We make them green by contracting for 100% of their load through renewable generation in front of the meter. So that's a combination of solar, wind, and hydro. And these are utility scale plants. We are not doing behind the meter renewables. We're contracting with in front of the meter renewables, just because the cost difference is very, very substantial. Brett, I think you've been in the wind and solar. My company built 400, I started the company. We built 425 megawatts of utility scale solar. So we know that space also very, very well. Now, our customers also need to have a backup generator because, again, if the grid goes down, they got to keep running. So they have to have one, but really don't want to because it's just an insurance product, right? It's like, how often does the grid go down? Well, fairly frequently, but it's still an expensive thing to purchase, but they essentially have to have one. So what we figured out how to do is how to combine those in front of the meter renewables with behind the meter generation and use that behind the meter generation to manipulate the way the load is presented to the grid in order to achieve those three things: green, resiliency, and save money. And here's sort of the underlying economics of that. Most of our customers, and again, we only work in deregulated markets, by the way, our average customers' electricity bill will comprise 40 to 50% of it will be non-energy charges. And those are dominated by demand, capacity, and transmission charges. By using the backup generator at the appropriate times, we're able to substantially reduce those costs. So if we say 50% of their bill is, non-energy charges, we start there, is non-energy charges, and half of those are, which is a very low number, half of those are demand, peak demand charges. That's 25% of the bill. And we can knock those peak demand charges down by probably 80 or 90%. So we can immediately reduce the overall delivered cost of energy to the customer by 20%. Now, the next piece is that our customer has a standard commercial and industrial tariff. The energy rate in a commercial and industrial tariff is fixed. And the reason it's fixed is because energy markets or electricity markets are highly volatile. And most companies do not want to take the unpredictability risk of changing energy prices. You can take as a great example, somebody in ERCOT, right? A company in ERCOT in the wholesale market would have done great in February and lost money in July and August because prices range in ERCOT from a penny a kilowatt hour to $90 per kilowatt hour or $9 per kilowatt hour. And in the summertime, those numbers spike. So they pay a tariff rate that essentially compensates the generator for that price volatility risk. Essentially, the customer's paying a premium not to have volatility. But what we do is by essentially contracting with the wholesale side and locking that in, we really don't care where the energy price market is going, because we have a fixed price for that contract with those renewable generators. So the market can bounce around and everything else. Our price is fixed. And the reason that works is because, again, with your experience in renewables, the renewable guys need long-term offtake agreements. They need long-term PPAs, since it's a capital play completely in the asset. So they're willing to sign an agreement at basically the average LMP, the average wholesale rate over a long period of time. Now, that average wholesale rate is only 80% or 70% of what the tariff rate for that energy is. Remember that customer is going on a standard tariff. He's he's essentially financing the premium for the volatility by contracting at the average LMP. We can essentially knock his energy prices down by another 20, and in many cases 30%. So we look at it this way: is from the demand charge perspective, I can reduce their overall bill by about 20, and then from an energy, so 20% times 50% of the bill, right, is 10. And then for the other piece, which is 50% of the bill, I can knock that down by another 20 to 30%. So in general, our process will reduce the overall delivered cost of energy to the customer by about 25 to 30%. Now, on top of that, what we do is when the grid prices, again, we essentially, the play is volatility. Grid prices are highly volatile, especially in places like ERCOT. So when prices go up, what we do is demand respond. I was waiting for Brett to get on the echo.
Sorry about that.
That's your Peter Frampton moment.
Yeah, so when grid prices go high, we do a demand response call to the grid. So then in that particular case, we're basically earning 3 times or getting paid 3 times for the same energy. In a demand response, the grid pays us the current wholesale price to take the load off the grid. Now, that wholesale price is now high. That's when we demand respond. The customer is still paying us for the energy because we have a long-term contract. They buy all of their energy from us, regardless of where it comes from. So if it's coming from behind the meter natural gas generator, they're still paying us the same amount. So the grid's paying us, and then the customer is also paying us. And then lastly, we have a contract with renewable generation. Now, I can't deliver that energy to the customer because I've taken the customer's load effectively off the grid. But that contract with renewables is at the average LMP price. And then when we demand respond, the LMP price is above the average. So we turn around, sell the renewables to the grid at merchant, which is a profit on that. We get a profit from the grid essentially paying us, and again, a profit from the customer paying us for the same energy. So I'll give you some really rough, dirty, quick numbers. let's assume that my contract with renewables is at, and I'm going to pick a number, 4 cents. It costs me a penny and a half to deliver that. So the delivered cost of energy is at 5.5 cents. The customer used to be at 8 cents. We take them down to 7 cents. Now, under just normal, everyday, great situation, they're paying us 7. It costs us 5.5 to deliver. We make 1.5 cents, if I got my numbers right, 1.5 cents for every kilowatt hour delivered. Now, again, remember, from the customer's perspective, they're saving money. They're 100% green because all that energy is green, and they've got a backup generator there free of charge for them. Now the grid price goes up. So rather than that 4 cents, the grid price is now at, we'll make the number 8 cents. The grid's at 8. I do a demand response, and we've automated all this in our software platform. We do a demand response, get a dispatch. The grid then pays us 8 for the load that we take off. The customer's paying us 7 for the amount that we're generating, so that's 15. The grid, we're selling the renewable to the grid at 8 because that's the current LMP price. So there's another 8. So 17, I got that right? Is it 15? 8 plus 7 is 15 plus another 8, 23. So we're now at 23 cents a kilowatt hour. Now we have to deduct from that our expenses. So the self-generation cost, typically, and this is for ERCOT under the current natural gas pricing and things, is basically 5.5 cents. So we got 23 minus 5.5 minus 4, which is what we owe the renewable guys because we're buying their stuff. So that's 9.5 cents. So 23 minus 9.5, I believe, comes out to be 13.5. Check me if I'm wrong there, David. 13.5 cents pure profit per kilowatt hour. So in our model, under normal operations, we're not doing anything. We're not demand responding. We're not doing anything. We have a gross margin of about 33%. When we demand respond, our gross margin can go anywhere from 35% to a few 100% on that, depending upon what the prices are. I picked the price of 8 cents in that demand response. Down in ERCOT, we've seen prices as high multiple times. They have a circuit breaker at $9,000 per megawatt hour. At $9, imagine you're self-generating at 5 cents and getting paid $9 for that same kilowatt hour. So Brett, I hope that at least gave you an introduction to the way the economics work.
Furthermore, Brett, I wanted to jump in. There are a couple other things you asked. What else have we done and built? That's just number one of about 4 or 5 things. We've also built a sales channel, both direct and through reseller partners. We've been out there selling our products or service as PPAs, and we built the software and have tested it, and now are going and getting that validated as well. So in answer to your question, what have we accomplished and built? It's at least those 4 things, and maybe Dave will pick up something else.
So I don't want to be the only one asking questions, but how many customers actually signed up today? And can you give us specific granular data, customer by customer, what their experience has been, how the economics worked out for them, and how they've worked out for you? And for some reason I have an echo here, apologize.
Yeah. So under this, so we started the company as a project company, meaning we did everything, the development, and in the project company side of it, we also did behind the meter renewables. So we did rooftop solar and everything else. We completed 8 of those projects. We sold them all for capital purposes, but what we found, and a lot from the direction of our board, was that it was really holding us back. It was holding us back because all of the project finance, especially the tax equity issues, and having to coordinate all the different contractors was holding us back. And they said, look, what you guys got is great IP. You know how to combine in front of the meter with behind the meter in order to, to create those values. You should really become a software platform. So we sold all our project, we pivoted around, we developed the software, and we are literally, Brett, now just moving into our first little commercial signings. So we don't have anybody signed up yet, though I expect to have the first deal, which is a company called Del Papa in Texas, should sign up. We've negotiated the PPA, all of that is done. They had a few, I was just on the phone with them this morning. It's been blessed by the owner. We have a few little tweaks to the power purchase agreement, and hopefully they'll have them signed shortly. We've got a great pipeline because, as Dave had mentioned, we have channel partners as well as direct sales. We have channel partners. Our channel partners are Cummins and Generac's largest distributor, and they're bringing us deals every day. We haven't closed any yet, but they're bringing us deals every day. And the reason is fairly simple. And stepping back, our customer is somebody who's going to buy or have a backup generator. In the case of they're going to buy a backup generator, they're looking at spending money. That's just, you have to buy a backup generator. So if you think of it from like Kelly or Generac's perspective, people don't like to buy backup generators. They're expensive. They really don't have any brand preferences. So it's a race to the bottom. They typically bid it out, everybody bids for it, and it's really the lowest price wins in that particular case. So let's say you're Cummins, you can go in and say, hey, you could, Mr. Customer, you could buy from Caterpillar and it'll cost you $1 million. You could buy from Kohler, it'll be $1 million. You could buy from Siemens, it'll be $1 million. You could buy from MWM, it'll be $1 million. Or you could come with Cummins Complete. And Cummins Complete it doesn't cost you anything. You get essentially resiliency and backup as a service for free. We make you green, we make you resilient, and we save you money. And it's just such an easy sale that literally I just had a meeting with Kelly, the Generac folks. They're worried there's going to be too much activity, that we literally have integrated our two CRM systems together. So they are up to speed and up to date on all the deals that are coming through in a bi-directional sense. So let me stop there, Brett. I think I threw a lot at you.
Furthermore, you asked, for an actual case study example. We have a project in Pennsylvania called Bardo Plastics. They were at the end of a power line. So their power quality is quite poor. And every time they had a power quality event, their systems would seize up if the power quality event went more than a handful of seconds. They were spending over $400,000 a year in energy. With the program design that was implemented, they then reduced that by about $34,000 a year, and they reduced all the cost of the outages, which is hundreds of thousands of dollars a year. So that's an initial case study we can point to.
Yeah, and that's a classic one where they were standard commercial industrial tariff customer paying that extra premium and also had a resiliency issue. Put in something to keep them running when the grid goes down, which was on average for them about 5 times a year. And by using that, then we took them and we put them on the wholesale index, right? Essentially, they didn't care about being green. So essentially contracting for wholesale energy, which immediately reduces their cost 20 to 30%. But then we use the generator to protect them from price swings doing demand response. So, and again, in their case, they saved about 8% on their overall spend and got completely resilient and saved usually about $250,000 a year in downtime costs, which not something we typically sell.
You guys have that list of the 8 projects you did, and over how many years was that? I think one of the issues that any investor is going to have is, do you have the ability to get these things actually closed and across the finish line? Because they are complicated enterprise type deals.
Yeah, no problem. I mean, happy to have you give those customers a call. We have most of them I think are in California, with 2 or 3 of them on the East Coast.
It would be great to see those projects, but my impression is those projects are really different.
Those projects are different. That is correct. So
Yeah, it's really not the same business model. It shows your ability to execute on building out something. but it's
Right.
not really the same economic model.
That is correct.
From a sales process, how similar or different was that sales process than this sales process?
It's relatively similar in the sense that there's a PPA, long-term PPA that has to get contracted and done, and then a project that has to be implemented and built and financed and so forth. We've simplified that model greatly by taking the capital requirement off of our balance sheet. We are a software company, we're asset light, and put that onto the guys who are really experts at that, and those are the distributors of the equipment.
I would say that the sales process for those is substantially more difficult. And the reason is our value proposition during that time, because we didn't have the full suite of our software platform. We had a far less competitive, far less, visceral value proposition. So we had a lot more competition from other developers and things who could spin pretty much the same story. Now that's completely off the map. There's nobody that does what we do.
What was the sales cycle though for those deals?
For those old deals, they could be months.
Yeah, I'd say anywhere from 3 to 7 months.
Yeah, right.
Right.
Typically.
Okay. Yeah, no, just having the list. I respect Brett's point that they're different, but I think they give us some sense of kind of where you're coming from in terms of your experience on selling.
What's important here is if the customer already has a backup generator and there are roughly 660,000 generators installed across the United States, then the sales cycle can be a matter of days or weeks, because there is no additional construction of your big construction and long lead times that have to be done. So the sales cycle is, I think, also partly a function of whether they need a generator or already have one.
Yeah, just to build off of what David said. So for example, we have a partnership with Kelly, Generac's largest distributor. They have branded our software as Kelly Complete. So they literally go out and sell, we'll make you green, we'll make you resilient, and save you money at the same time, doesn't cost you anything. They currently have 5,000 customers under contract that they currently maintain and manage their generators. And they're taking the Exergy, the Kelly Complete, to all of them. So we say, look, hey, we'll make you green, we'll save you money, and by the way, we'll have somebody take care of it's part of your service contract on your generator, et cetera, et cetera. In those cases, it's a real easy sell because they already got the customer and the customers are satisfied and happy. But it's like, hey, you've already got the generator. How about we make you green and save money? It doesn't cost you anything. It's pretty straightforward. And like I said, they're so excited about it that literally we get calls every day in that regard. And that's going to be true as we sign up additional folks as well. We're working with Cummings, with the Connecticut Water Authority right now. Connecticut Water Authority has 38 plants. I shouldn't say that. Has 38 backup generators for all their water treatment plants, wastewater treatment plants, pumping stations, and everything else. The vast majority of those are diesel Cummings. And been discussing it with the executives of Connecticut Water. They want to be 100% green. And they really would like to get rid of these diesels and do things like we're saying, use natural gas, do demand response and everything else. So there we have, a partnership with Cummings saying, how do we do a trade-in program for these people, and that type of thing. So once we start expanding that out, we just finished a sales training class for Cummings sales folks so that they know how to position the product, and they're positioning it as Cummings Complete as well.
If you get some pushback, because I would argue you're really not 100% green. You're creating and selling natural gas generated power for some portion, 5 or 10%.
Okay, so what I say is that 100% of the time, you get an initial pushback. And it always is invariably stated as the following. How can you say you're 100% green if you got a natural gas generator? The answer to that is, number one, 100% of your load is contracted as green, solar, wind, and hydro. So we supply 100% of your load as green energy. Now, putting green energy on the grid causes problems with the grid. So the grid sends out price signals that says we need help. We need help in demand response because we can't handle the variability, we can't handle the cost, we can't handle the load. So it behooves us to be a good corporate citizen or a good citizen in general to help the grid out by using that asset. But it's still generating 100%. If we can't deliver it, it is sold for them in the merchant market so that essentially it's an offset to what we generate. But the key piece of this to always remember is that that customer, and maybe this is a rationalization on their part, the customer has to have that backup generator. So
it's really, it's more of a marketing point, which is you're a very green solution.
Yeah.
You can only really call yourself 100% green, you know, through kind of an intellectual.
Well, I look at it as
offset, right? I mean, that's like saying, you know, so.
Well, let me say it this way.
Is that important?
And they're really a function of how reliable the primary power source is. And if you never use the battery backup, then you're never going to be doing it.
I'm sorry, I didn't quite follow that.
I mean, the backup is only needed when you have a problem with the primary source of power. And if the primary source of power is green.
No, you'll
do it when the prices spike as well.
Exactly.
Right.
Prices spike and demand.
Right, but then you're enabling it. Right. It's really a definitional issue. I don't know what the utility commissions have you know, what you can market if there's a, you know, the FTC or somebody else says what's fair game.
Well, the way I like to think about it is my wife and I, we chose to select the 100% solar option here in Berkeley. Does that mean at night we're consuming solar electrons? No, but it is a marketing approach. But I would also point out that we've done the calculation that even with a natural gas generator, on average, we're reducing their carbon footprint on day one by 91%.
Exactly.
So it's a huge, huge impact.
I don't think there's any debate that you have a huge impact. I'm just saying, you know, do you think you need to drive it from 91 to 100 in order to market this? I mean, play it that close to the line for kind of.
I'm open to that discussion. I'm open to that.
Yeah, I just step back a second, and we hold ourselves to a very high ethical standard. And if you want to compare everybody who says 100% green, we believe that we are head and shoulders above everybody else when it comes to actually delivering on that. Let me explain what I mean by that. You got the people that'll say, we'll make you 100% green because we're going to sell you these worthless wind wrecks from Texas. To me, that's just bullshit. Yep. Then you get people say, oh, we're 100% green because we're buying all the power from this solar farm or this wind farm. Well, yeah, but when's it delivered? So, you know, as Dave was saying, so in the middle of the night, you're offsetting your kilowatt hours on an annual basis, but you're not actually load and generation matching, which is what we do. We literally match their load on a 24-hour basis with renewable generation on that same 24-hour basis. And that's why it's a combination of wind, solar, and hydro, and literally located in different areas in the country.
Okay, I don't want to belabor the point, but just
that's fine.
Curious as how
it's a good question, though. I like it.
Because part of being the high integrity player, and I think you're smart to do that, is to not being perceived as being, you know, cute.
Right.
And like I said, you know, maybe the customer has a little bit of rationalization because they need to justify that generator. But they go back and they say, okay, you are generating 100% of my load with renewables. And for some of the times you can't deliver it, but it's still being generated. Yep. I'm fine with that.
Yeah, Brett, don't be bashful. I mean, I was talking to these guys last night. We've been in touch a lot, so I've had lots of time to ask your questions. really for you and Josh.
Brett, you're on mute.
You're on mute, Brett.
I'd love to get detailed economic models of what you're pitching to the customers and what the actual expected and real numbers are. You know, I don't want a 100-page spreadsheet. I'd like it hopefully in a Cliff Notes version that I can understand. I don't expect to go over it now, but if you could send it to me with a brief explanation of kind of how you're pitching it. I'm looking for the customer's perspective on the economics. And frankly, maybe it's the whole customer's perspective on the pitch, of which a portion of it is the economics.
Yeah, so philosophically, and actually, Mark, you asked me this question last night, and I did a very bad job on it. So maybe I'll do better today. Why us? You know, and the question is, or the answer to that question is, we're the only group that is truly customer focused. We focused on what does the customer want and need that they're not getting from the market today. They want to be green, they want to be resilient, they want to save money, and then there's a few extras that I typically add. They don't want to learn anything, they don't want complication, they don't want to, they're not going to pick up their iPhone and see, hey, what's my load doing right now and everything else. It's make me green, make me sustainable, make me resilient, save me money, and leave me alone. So from the standpoint of the economic discussion to them, Brett, is exactly that. We'll make you green, we'll save you money, we'll make you resilient. You get one price per kilowatt hour, and whatever your load is generated, we charge you that. Your bill is simple, it's got one line, this many kilowatt hours, here's the price, boom, you're done. You don't have to learn about microgrids, you don't have to learn about demand response, you don't need to learn about anything.
So let me just ask the question then. So you're basically telling your pitch is a one flat price per kilowatt hour, and you're basically absorbing all the variability of what that is.
Yes.
And so, I mean, you're basically effectively almost writing like an insurance policy, or a financial policy, maybe is a better way to characterize it. You know, you're going to pay 6 cents a kilowatt hour, just to pick a number, and we're going to absorb all the risk. And if it costs us 4, we're going to make 1 cent a kilowatt hour. And if it costs us 2 cents a kilowatt hour, in my fictitious example, and if it costs us 8, we're going to eat the 2 cents. And so one of the things we need to understand better is where the risks are of you being able to deliver it for 4,
right,
in my example, versus, you know, when are you going to have dislocations in your ability to procure the power?
Right. So, Dave, on our notes, so to Brett, we want to send like the Bell Papa model, how we do it. So it's the actual transactions hour by hour for a company.
Yep.
Right. Right.
So to relate to your specific question there, so where is the variability and where is the exposure? And as you can tell from my backdrop here, I'm the engineer. Iju, who you can't see, is our mathematician, and Dave is the finance guy. So we model, simulate everything. So first, the renewable generation is under contract. So we essentially are just using the grid to transfer that energy from point A to point B. So there's no risk in the change in price of the energy at that point. There is a risk or a change in that the delivery costs. So right now we reduce those by peak demand, reducing your peak demand and things like that. But those prices could go up. Absolutely agree, could go up. However, if they in fact go up, then the value of self-generation goes up by the same amount because you can offset those. So what we call the strike price of when we would do demand response literally goes down with an increase in distribution charges. So we've run these numbers and you could double the distribution. Remember, the renewable stuff is locked. You can double the distribution charges. Again, let's say for ERCOT, et cetera, the only impact to us is approximately a 3%, under that circumstance, about a 3% reduction in overall profitability for a doubling of distribution charges that we couldn't offset. And it's again, because we have the self-generation side. Now,
But
your
doesn't
next,
that vary from state to state based on what the rate you get taking stuff out of the grid versus putting it back? I mean, that generally is regulated by each public utility commission. It's not you nationally. And FERC provides guidelines there, but the state public utility commissions regulate it.
correct. So you've got essentially, think of it as three charges. You've got an energy charge, which again, we're only on the deregulated markets. That's in the generator side under FERC. You got the transmission charges, which depending upon what RTO you are, you've got capacity, transmission, and demand. And those are also regulated by FERC. And then you have your local distribution charges, which are handled by the local distribution utility. So those are the ones that we are primarily exposed to, is what I'm referring to. So I think I'm answering, I don't know if that's Brett or Josh who asked that question. So yeah, those are unique to each individual utility, distribution utility. So we do take account of that. So for example, Atlantic City Lighting has some interesting regulations as a utility, as a distribution utility that you can take advantage of, that are the only people that have that one. You know, it's kind of odd that way. But all I'm saying is that because we always have that optionality of self-generation, and we are 100% or essentially long their load in non-fossil fuel or locked in prices, our exposure is very, very small. Now, the other piece to understand is, and I don't mean it in any pejorative way, the grid typically, the merit order of the grid price clears on natural gas times heat rate times ramp premium at that time. So the grid literally clears on a natural gas price. And Mark, if you're interested, we have all the academic literature on that and stuff from NREL on how you use wind and solar as hedges against natural gas. Essentially, you use wind and solar in the electricity markets as a proxy hedge. In that particular case, then, if the grid price goes up because natural gas prices go up, yes, our self-generation cost goes up, but the delta between the grid and self-generation remains constant, such that we do this, demand response, essentially is the same profitability regardless. I'll stop there. Throwing a lot at you guys.
And again, we'll send you the Del Papa model and the how we do it, which will give you a lot more detail. And there's even a spreadsheet where you can go and plug in the numbers and say, all right, but what if prices go to here and natural gas goes to there and da da da.
Right,
And you get to.
Pardon?
No, I was gonna just two other questions, and I'll look forward to getting the models. That's helpful. So for a typical customer, these are large commercial accounts.
I'm going to say we deal primarily in upper small and medium size rather than large. And then I'm going to say.
So what? When you say what does that mean in terms of their monthly electrical bill? Just a range of prices. This is our sweet spot. People that are paying X to Y. What is X to Y?
Oh, on a monthly. Let's take Del Papa. What is a monthly Del Papa site?
Give me 1 second.
20, 30,000, I think.
It's going to be
40,000.
40,000.
Yep.
Okay, so on average 40,000 a month. Okay, so that is that kind of plus or minus the targeting, and do they typically have a backup generator in place before you get there, or are you putting that in and that's built into the whole pricing mechanism in the model?
So I'm sorry to answer it in the following nondescript way. Some have them and some do not.
Okay, so you'll price it either way. Okay.
We price
in some cases you're putting it in for them. In some cases you're working with their existing backup facility that they put in prior to you getting on the scene.
That's right. So in the case that they have a generator, then we have no financing cost for that generator that the SPV has to handle. So they just get more savings than somebody that needs a generator.
Right. Right now, obviously your pricing would change and how you would bid it, whether they have a generator or not.
And also the tenor of the contract. So if they don't have a backup generator, then they're going to sign a long-term agreement with us to buy all their electricity through us. The tenor of that is a function of how much they want to save. So if they want to save maybe 5%, it's a 10-year contract. You want to save 10%, it's a 15-year contract. You want to save 15%, it's a 20-year contract. If they already have the
But you're not getting to the point with the backup guys that already have a generator where you're actually offering to sell their excess power into the grid. You know, the way Tesla's now doing with their cars.
Okay, so let me address that in a couple ways. One, no, because you don't want to sell to the grid. And let me explain why. In a generator has to be registered with the grid as either a generation asset or a curtailment asset.
Cannot be both.
You can't be both. If it's a generation asset, you only get paid for what you generate. If it's a curtailment asset, then you get paid for the demand response, which is still the amount that you generate, but you can't demand respond if you're a generator. So that's just typically the thing. There's also, as a generator, you have to post additional sureties and things like that you don't have to as a curtailment asset.
The other benefit is a battery has a limited capacity, limited amount of energy it can hold, and thus limited amount of participation in the market. Our natural gas generator is only limited by the supply of natural gas, which is by far one of the most resilient and high level availability fuels in the marketplace.
Try and make it a little bit more concrete. Let's assume I have a 1 megawatt generator and my customer is currently running at 800 kilowatts, okay? If I do demand respond, the grid will pay me for all 800 kilowatts. If I do generation, I turn the generator on to a megawatt, I eliminate the 800 because that load's gone away, but the grid only pays me for 200. So I'm not getting paid twice for the load. I'm only essentially getting paid the PPA for the load. And this has to do a little bit strategically with the type of customers that we go after. We like customers with relatively flat loads. That's why we like, refrigerator warehouses, right? They don't change over the years.
You don't want a steel mill that's going up and down.
No.
Okay. And then one unrelated question, or maybe it's related, but different. What are you doing here that's particularly proprietary? This just seems like this is a methodology and you're kind of tinker-toying together the economic model. I'm not trying to make a mundane comment about what you're doing. It's very interesting. But is there anything that's particularly proprietary and provides you a sustainable barrier to entry?
Let me address that one first by a comment from Constellation Energy, who was going to invest in us, but they put their VC thing on hold. Quote, Dave, we could do everything that you are doing. We just can't do what you are doing because there's no way for us as an organization to get all of the different silos to work together to be able to go to market with such a value proposition. So we want you to get as big as possible so we can essentially use you to go after that market space. Now, that being said, is there anything very proprietary? I'm going to say no. There's a lot that we've done that will be extremely difficult for somebody to duplicate it, but I believe in most technology markets, people can duplicate things. So we've done like all the statistical analysis, know how all the nodes will
It's really methodology and expertise. Would you agree with that statement?
Yeah, I was going to say it's methodology, expertise. I'm going to say it's also brilliant software architecture that allows us to scale, I think, better than anybody else. But I think more importantly, what is unique is basically the philosophy behind our focus, which is, I hate to use the term customer first, but it's customer oriented. We're not going out trying to sell microgrids, right?
Nobody wants to buy a microgrid.
Nobody, yeah. What do people want? People want this. That's what we provide. And we focus completely on that. We make it as easy as possible. Everything we do is focused on making it easy for the customer to sign up, to stay with us, and most importantly, to be as sticky as possible. So don't make them think, don't make them learn things, and keep them satisfied with green, resilient power.
At the risk of beating a dead horse, who would do what we're doing? Who would come along and copy us? Is it the generator guys? No, they want to sell and move heavy equipment. That's their business model. Is it the ESCOs? No, they have a completely different business model that doesn't line up with what we're doing. Is it the Constellation Energy Utilities of the world? No, they are too big, too siloed, too everything. We can go down every single one of the players. And could they do it? Yeah. Will they do it? Pretty unlikely.
I mean, I'm involved with another ESCO just for fair advertising. I think Mark's aware of that. I'm not sure I agree with you. I think a lot of the ESCOs are trying to figure out how they differentiate themselves, given all the backlash they've gotten from the public utility commissions on the retail side, and given their margin, their opportunity is getting contracted, like it has done for a lot of things. Their value proposition is clearly declined over time, I think, by any rational measure. So I think some of the ESCOs would look at this. I'm not sure I agree.
Brett, I agree with you. The ESCOs would look at this. The ESCOs could.
Whether they have the expertise to be able to make it work and make a compelling case and put it together. Well, some of them clearly don't. I would agree with that statement.
Yeah, but you're also, like, you got experience with an ESCO. So ESCOs, they had a great run because they were able to harvest, the low-hanging fruit. We did the LNDs, we did the VFDs, the energy savings were pretty easy, et cetera, et cetera. But each additional energy efficiency investment costs more, longer payback, more complicated, and everything else. So ESCOs had to stand back and say, how do we continue to grow and things like that? So they've tended to expand more into now building services. So they don't only just do your electricity, they're going to do your water, they're going to do your landscaping, your architecture, and a whole variety of things. The size that they're usually willing to go after is typically larger than our sweet spot. So they tend to ignore us, tend to ignore us. But yes, technically, sure, I think they could probably do it. Which at the same time, our claim to fame is the customer focus, the ease of use, to sign up and everything else. Having people that could do it is actually beneficial to us. One, if you think of it as competition is good because you get more people out there getting the market stirred up. But if we think about it from an end game perspective, hey, some ESCOs may in fact do it, and maybe they're earlier on than others. Somebody's going to take a defensive position on this thing and say, hey, we ought to buy those Exergy guys. So I don't look at it necessarily as a negative.
I mean, look, if there's good margin in your model, right? And it implies that this is an interesting market opportunity, certainly large. We know that there will be competitors, right? I don't know if they'll be ESCOs or who they might be, but they'll, as you said, there's nothing proprietary here, no credible barrier to entry. So you'll have competitors. I think the question is, what does that do in terms of margin compression over time? Have you factored that in? And are there sort of countervailing margin enhancement opportunities down the line that you're particularly well positioned to take advantage of?
So we look at it in two dimensions there. One is on the longer term basis, the thing that determines sort of like the winner in the market is the customer acquisition cost. So being the first mover and taking that advantage, gaining the momentum, gaining the brand, and more importantly, locking up the best channels of distribution that can bring you those customers will always keep you in a preferred competitive position, in my opinion. And I said there were two things, I forgot the second one. The margin compression is a function of two things. One is what's the cost of capital? And since we are not putting any capital into the renewables in the front, and the generators, the cost of capital is basically the lease function, the lease cost, they're already at the market, sort of like at the market optimum anyway. So could they compress how much we make on a return by essentially giving greater savings, yeah, they could try and do that. Absolutely. We can always respond that way as well, and if necessary. But again, I think that the first mover advantage, getting that customer base, and again, focused solely on making it easy for the customer to buy and remain is the key. Because, again, word of mouth and everything else, and we've got enough people out there selling for you. So they have to duplicate our sales model, they have to duplicate everything else we've done, but almost more importantly, they have to duplicate a culture and a philosophy that I'm not sure other organizations are going to be up to it.
Are your channel partner relationships that are of significance with Cummins or whomever else, are they exclusive?
They are not exclusive. And the reason for that is, why make it exclusive unless they're willing to up something? So that's why we give them the ability to brand label. But I'm not going to give it, Cummins an exclusivity at this point in time without guaranteeing.
I think the opposite question.
Yeah.
Can Cummins have 3 other Exergys?
Could Cummins have 3 other Exergys?
Yeah, as partners.
So I'm going to say no, and for the following reason. One, there aren't 3 other people, but more importantly, what they want to do is have a single solution. They want to go to market with Cummins Complete. They don't want to go with market with Cummins Complete 1 for this geography and Cummins Complete 2 for a different geography. Their marketing team would never get behind it.
Other than branding, why can't Cummins Complete have somebody else under the covers? Right. And even from a branding perspective, I don't know if that branding is contractually is a contractual relationship that includes Exergy or not.
Could you repeat that, Josh? I sort of lost a little hold on that one.
Yeah. So to Mark's point, and that was really what the nature of my question. Why can't somebody else be under the hood that the customer is, it's opaque to the customer. The customer doesn't care. But if the same value proposition is presented to the end customer, wouldn't Cummins benefit from having 3 Exergys to be able to pick and choose from?
Well, one, if they're the ones that are going to market as Cummins Complete, it's unlikely, in my opinion, that they're going to have 3 other people, because then you got 3 different integrations and things like that, because we control the Cummins generator. So there's a lot of overhead expense in there. I'm not sure what it buys them. The thing that's more important is why Cummins wouldn't do it themselves is that product companies don't like services. They like to get paid for their, I want to get paid for my generator, make it easy for me to sell that. If it's Cummins Complete, that makes it easy to sell. But we don't really want to manage this stuff internally. We just want to use your platform to get generators sold.
The other aspect of this is if they were going to add somebody else under the Cummins Complete brand, that group would have to go through all the testing and validation and everything that we already have done. So there's a long lead time, and in the interim, we've got the advanced knowledge of the market, and also we're getting that customer acquisition cost down. Customer acquisition cost is, it's the biggest issue. So.
Yeah, and I think that was Josh who's asking the question, right?
It was, yep.
Yeah, so Josh, it's happening now, okay? So Cummins has a joint venture with a company called Tangent, which does behind the meter, generator management and stuff like that. They're very unhappy with it. And that's why Cummins sales go to us, is because it's too complicated to sell to the customer. It's like, hey, we've got Cummins. Oh, and by the way, we have this other group here that'll do this, but you got a separate contract with them. And oh, by the way, you still got to buy the generator and then contract with these guys. And then you send them your energy bill at the end of the month, and then they'll figure out what you owe them because they did these actions. Customers just don't want that. They want simple and easy. Generac just bought Embala. Embala is a behind the meter, essentially generator management system, that, go to bid in, demand response and everything else. Same thing. I mean, literally, we're working with the largest Generac distributor. And they came to us and said, don't worry about Embala. We can't sell it. We can't sell it because it's yet another piece that has to be sold. They still have to buy the generator. Then they got to sign up for this program, et cetera, et cetera. We prefer Kelly Complete.
Yeah. Look, I'm not disagreeing with it. In fact, I think I agree with you in the near to intermediate term. I have sort of my greedy venture capitalist hat on that's thinking longer term, kind of on the exit horizon, saying, what is a prospective acquirer, look at in terms of the long-term opportunity of the business, the long-term margin structure, what are the implications in an industry where, again, if this is attractive as it looks, you're going to have serious and likely capable competitors 4 or 5 years from now, right? It may not be 18 months or 24 months from now, but we'll see them later.
I guess in some ways, every market has to, every company's got to address. There's going to be competition. I mean, that's just sort of general economics, right? But again, it's sort of two things. Excuse me for a second there. I apologize. I should have turned that off. The first one is, again, the first mover advantage. The second one is, and I come back to sort of software architecture. We wanted to make sure that we had a platform that could scale and does scale to potentially managing millions of behind the meter assets. Because let's think about it, right now our target market is those always on customers. You're 24/7, got to have a backup generator. Okay, that's the low hanging fruit. But what happens as battery costs continue to decline? As battery costs continue to decline, that can open up the sort of the avenue for additional customer types. So commercial buildings that don't have to be resilient across 24 hours or a week, but maybe a few hours at a time. Residential, a battery with residential, et cetera, et cetera. Our platform can manage all of that. So we're going after, I always hate to use the term, we're going after that low-hanging fruit with the highest potential value proposition. But we've just signed up another company, I didn't mention that, a company called Penn Micro that does microgrids for municipalities. They've standardized on our software. We're signing up another company that does residential solar plus storage. They're using our platform as well. We can continue to expand. And that, again, it's all about that customer focus.
Okay, thanks.
Could you maybe just briefly go through on this first deal that you think you're going to land, what your economics look like? What's your annual, what kind of?
Hey, if you want to actually bring up the.
Yeah, just give me 1 second to pull up the model.
Yeah, I really just want to focus on your profit, kind of how it contributes to the reduction of your net cash burn. Right, so these guys can have a mental image of, if I did 10 Del Papas, I would have enough to break even in 6 quarters or whatever it is.
Okay.
And then I'm going to need to hop, guys, for something else I need to go do.
Fair enough. Okay, so do you want to start on the summary page? I'll just give you some high level. The two sites combined are about 900 kilowatts. The all-in cost is about $1 million for the system. We're starting them off at a 6.5 cent PPA with a 1.5% escalator over 20 years. That's saving them, I think it's about 11% from their current 7.4. When the numbers are dropped in, there's some assumptions built in here, which is that while we have the possibility to demand respond up to 4,400 hours a year, we're not going to assume all of that. We're only going to assume the best 2,500 hours. And so there is potentially a little bit of upside here. But bottom line is it's about $400,000 to $500,000 a year of revenue. Operating cash flow starts at 153, goes up to 214, up to over $250,000 a year. And then, for $1 million of equipment being put in place, you can see the payback is pretty incredible.
Right. But you have to assume, how do you finance that $1 million, and what's the cost of that capital? That's
So
not
the
in
cost
here.
of that capital, we've had long discussions with guys like Hitachi Capital. They'll provide up to 100% of the financing over a 10-year capital lease, and that you'll basically have a fully amortizing cap lease, maybe with a $50,000 or $60,000 buyout in year 10. Then you still have excess cash flows available to us.
No, I understand. What's the cost of that money, though? What is that $1 million going to cost you on that lease?
It's going to be about 6% or less, given the good credit of
All in?
All in.
I'm shocked. Okay.
Well, this is a really good credit. This is a $200 million a year company with very, very little debt. 17, 18.
No, but there's a lot of risk on the project itself. So if the project has any issues or anything,
Well,
I guess the $1 million lease is with you, or the $1 million lease is with the customer?
the
With
million-
us. Well, with the SPE.
Yeah, the SPE. One thing that one always has to remember through this is this customer was going to buy a backup generator anyway. Okay. So there really isn't that much risk in the program.
And how much was that backup generator, David?
It was $990,000.
So it's basically the same price you're leasing. It's the exposure for the customer is no different than it would if he bought a backup generator himself.
You got it, exactly. So like if, and I hate to say in French, but if everything went to shit, right? The customer.
Right. So you're basically financing that backup generator in this specific example, effectively the same if he just bought his own backup generator.
Exactly.
Except
Right.
he's getting
There's no risk of Exergy in that leasing price.
none.
Okay.
And again, we only use, tier 1 equipment. It's
Right.
This is,
But this, to Mark's question, this generates, between $10,000 and $20,000 a month of cash flow once it's up and running.
Well, the first year now, the first year it's only
It's $150,000 the first year.
right? Because you're getting 150, but
Right.
you've got your interest on your CapEx.
Right. So if you assume PMT 6%, number of periods 10 years, 1 million, just for the sake of round numbers, we're still clearing. Let me do it this way.
I mean, you can only be clearing if you're paying 6% on $1 million, right? That operating cash flow gets dropped to 92,000.
Yeah.
Yeah. So, by year 2, we're generating 78,000 of excess cash flow here and rising. And then you get to re-up. Because that's 10-year money, you get to re-up it and and pull out a whole bunch of money in years 11 and out. But we're also looking at other financing sources that will give us 20-year money. Haven't locked that up yet. And then, you have a lot more
I'm
available.
just focused on the first 3 years from now. We can talk about long-term risk, right? But am I missing anything?
one thing I'd like to explain, the first year you'll notice profitability or cash flow is not as high. And that is because the demand charges, transmission charges, which are done on peak demand, are basically done in arrears. So what you pay this year is based upon what your peak load was at a specific time last year. So once we get the generator in and we whack their peak demand load the first year, we don't get the benefit of that until the second year.
Got it. Okay.
And then,
guys, I'm going to need to run. Anything else before I hop? And I look forward to getting the additional material we talked about.
Unless there's a, question that you want to contemplate while you're running,
No, I think I'm good.
Thank you so much. Really appreciate
Mark,
it.
Josh, we can catch up about this later.
Josh, what kind of other remaining things do you have?
I think I'm okay.
Just before we close, David, you may want to just talk about your current gross burn rate is, just so these guys know, is how much a month?
So we're right now, if once we're funded, we're going to have about $190,000 to $100,000 a month in burn. But we want to hire some more salespeople, so we want to bump that up a little bit. So
Sure.
we're thinking 1.5 million would probably take us about 3 quarters.
Okay. So you're going to take your burn up to 150,000 a month, 180?
About that, give or take.
Okay.
And that 1.5 million, that's to include your existing investors, but how much are you looking for outside of what they're willing to commit of the 1.5?
So they're very, very flexible. So, I don't know so if you guys wanted to come in for 1.5, then they would come in for something more than that. I mean, not more than 1.5, but they would come in above that or so. I don't know what your sort of minimums are. We have, the current investors do want to come back in, though we're not as strategic as we were when they were our angel investors, because they're only interested in large utility scale stuff anymore.
And who are your existing investors?
A group called Green. Do you know Greenbacker Renewables out of New York? They're an $800 million asset management company, buys utility scale solar, wind, et cetera.
Don't know.
Publicly listed.
It'd be great for you to talk to them. They're
Great references.
Why don't you send that intro up? I mean, the way we think about it simplistically is, hey, if you're burning 180,000 a month, and we got to get comfortable with the kind of unit economics, right? How many projects do we need to sell in order to get the company to break even, and how long does that take us?
Right.
Right. And I think we sent you the business model, the
Yep.
detailed one, and you have that is all in there. So under that particular model, which is the high growth one, walls to wall, blah, 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 blah. I think it takes us approximately 3 years to break even, and I don't remember the number of customers on the top of my head on that one.
Yeah, so that's just, we're gonna have to, we'll look under that and with some of the assumptions on lease, and in order to get to that,
Yeah.
right?
Again, because the work has really been done in most cases, we can always scale back the growth and therefore the burn and everything else, but I'm not sure it's the best long-term value, because
Yeah.
this is a first mover advantage. Get the customers, get the momentum.
Mhm.
And in our model, it's by the 10th quarter, we're free cash flow positive. And that's basing it on the average customer being a 0.5 megawatt load. Some are going to be much larger than that, of course. And by that 10th, we have 39 new customers, a quarter, 140 total in place. So that's what, 70 megawatts.
Mhm.
Anything else, guys?
I'm sorry?
I was just checking with Josh to see if he had anything else.
No, I'm all set, thanks.
All right, guys, thanks for your time. And yeah, I'd love to get the intro to those guys, and obviously copy everyone on the distribution of the that sales presentation stuff Brett wanted.
Great, perfect.
Absolutely.
Josh, nice meeting you. Thank you, Mark. Thanks so much for putting this together.
No, enjoyed it.
Take
Thanks,
care.
guys.
Thanks.